And we want to just get in a specialist on it. Karan Taurani is with us.
Indeed, Karan Taurani of Elara Capital is also now joining in. He's the Executive Vice President. Karan, thank you very much for joining in. Now, you've had about 48 hours to assess all the changes in the Labour Code. They're simplified, consolidated. But in the near term, there could be an overhang or some cost implications for gig economy workers, Swiggy Eternal. Going by the stock price yesterday, it didn't look material because stocks recovered, closed pretty much flat. But take us through your assessment, and are there any changes to your EPS estimates basis this?
Hi, Ima. So firstly, I think in terms of this impact, this will have a negative impact in terms of the cost for the food tech and the quick commerce companies, because gig workers is a very important segment in terms of the last mile delivery for them. Look at it here, I think there is a negative impact of anywhere in the range of 30 to 50 pips as a percentage of GOV. And on a per order basis, this number is around 2.5 to 3 rupees on a per order basis. So I think most of these companies are already providing benefits to the tune of medical insurance and some bit of maternity benefits as well, which is around maybe 1% of the top line or closer to that. This could potentially move higher to 2% of the top line. Now, the code clearly says that it has to be either 2% of revenue up to 5% of gig worker payout. So even if you put a scenario here that it is up to 5% of gig worker payout, even basis that, the worst case impact is not more than 2.5 3 rupees on a per order basis. The impact in terms of numbers is about 250 crores on EBITDA for both these companies on an average roughly. In terms of the negative impact on the margins, we don't see a big material impact on the medium to long-term perspective because as your revenue scales up, this impact will kind of become smaller with time. And secondly, I think we do see a potential that this will eventually be passed on to the consumers. So I think if you look at the AOV here, on the food side, the AOV is 40 rupees. On the QC business, the AOV is 600 rupees. As a percentage of AOV, the 3 rupees number, which is a negative impact, it's a very small component. So we don't foresee a big negative impact even in terms of this impact being passed on to the consumers or if they are asked to pay for these kind of charges incrementally.
All right. Hi, Karan. Good to see you, Ben. So you're saying that 3 rupees will be adequate to push through any kind of hit, right?
Yes, absolutely.
All right. And both the stocks, if I look at Swiggy as well as Eternal, they've come off a good deal from the top. And yesterday, in fact, Swiggy started off in the red, but then we saw a sharp recovery. You think the stocks are at good levels to buy?
Yes, I think the worst seems to be largely over as far as Swiggy, Zomato are concerned in terms of valuations. If you look at Zepto's recent fundraise, if we assume a 50% CAGR in terms of their GMV and the fundraise that they have done, it's about 0.6 to 0.7 times market cap to GMV. Now, if you look at Eternal, if you assign a 50 times EV/EBITDA to the food business, which could be debatable, but we do see a premium multiple there because the business is duopolistic in nature. You are seeing better growth prospects and EBITDA margin improvement is also there from here on. So assuming that, and then assuming the cash balance and assuming the other business valuations, which is the Hyperpure and the events business, you are getting a quick commerce business today, the Blinkit, at about 0.6 times market cap to GMV, which is similar to the likes of Zepto. Now, because Blinkit is better in terms of growth rates, better in terms of scale, better in terms of profitability, we do see Blinkit trading at least at a 50% premium valuation as compared to Zepto's last fundraise. So basis that, potentially, if Blinkit has about 60% valuation contribution in terms of SOTP for Eternal, you see a straight 30% upside from here on. So I think the worst seems to be over in terms of valuations basis this at current price point. Second thing to look at here is the discount, right? The price wars. So the kind of price wars we saw in the month of Feb at the start of the year in CY25, with Zepto coming in aggressively in the market, we don't see those kind of price wars here in. I think most of these companies are now going to try to focus on profitability, and Zepto also will eventually want to go for IPO. And Swiggy's recent QIP is more for moving away from 3P to 1P in terms of inventory model in the QC side for reducing the foreign investment and not because of price war discounting. Another important point is many of these companies like Amazon, Flipkart, which are making foray in the QC side, are not looking for price wars, but they're betting on execution rather. So I think if price wars is behind us in terms of worst, we don't see increase in terms of losses for these companies here on, unless you see a lower throughput per store in terms of the expansion that they're doing right now. The non-metro markets today have got lower throughput per store. So if that has a negative impact on the profitability, that could be a case in point. But external forces or price wars are behind us largely.
Okay, all right. before we let you go, you're bullish on both these two names with a substantial target price, which is 25 to 30% higher than current prices, I think, on both of them. I think on Eternal, it's around 415 rupees. What are your other picks? You track a whole host of stocks. If you could name a couple of them.
So in terms of other picks, we are currently liking Jubilant FoodWorks. I think we mirror this company to food tech companies. I think we do see strong growth for Jubilant FoodWorks because of LFL SSG traction coming, and they are the only QSR player which is reporting growth. Obviously, LFL growth rate will converge because of a high base over the last 4 to 5 quarters. But on a steady state, we do see LFL growth rate of 5 to 6% and store growth of about 8 to 9%. We do see margin expansion as well playing out. Other QSR companies are reporting a lower margin. The margins are coming off because of price war. In pizza as a category, the competitive intensity is the worst seems to be behind us.
Okay.
The competitors are either scaling down or not expanding aggressively. So that could have a positive impact in terms of their margins as well. So I think Jubilant FoodWorks we like as a top pick apart from Eternal and Swiggy as of now.
And any view on Restaurant Brands Asia? My colleague Vivek and I think Mangalam, they were working on a story yesterday which we had filed that the P could possibly looking at exiting. Any view on that name?
Yes, we do cover the stock. We have a buy rating on the stock as well. I think Restaurant Brand Asia, the India business, has done reasonably well as far as growth rates are concerned. They have consistently delivered a better SSG, positive SSG as compared to peers. And even the store growth has been good from their end. The problem from their end is margins in the India business, which is quite low because they've been going for a price war. But as the growth rate picks up, as operating leverage does pick up, we see margin improvement as well. The key monitorable for that business in terms of rating or valuation multiple for the overall business will be what happens to the Indonesia business. Indonesia business is currently making losses, and they've tried to scale down in the last 4 to 5 quarters. But once we see a potential exit or we see Indonesia business going to a break-even point, is what will trigger re-rating for this stock.
Okay, got that, Karan. Out of time. Thank you very much for joining us with that precise commentary on how you think about the labor law impact on platform companies and, of course, your thoughts on other names under your coverage as well.